Today we'll discuss price action trading. When it comes to price action trading, one of the key features of this system is that it does not include any indicators or overlays with the exception of the price chart as we are seeing in front of us, coupled with the volume. The volume chart is obviously visible here as an underlay to the price chart. And price action trading is obviously simplistic in its approach. There are many individuals who prioritize this system of trading because of its efficiency, so to speak. And there is obviously serious merit in trying to pursue this type of trading or include this trading style into your own trading system. Personally, I include price action into my trading system, but it is just a matter of assigning weights. And my personal weightage is always assigned in the direction of trend. But when it comes to price action trading, here essentially we are looking at the price as it is in relation to its previous highs and lows and the volume. So now the question is, how do we go about with this process? So here I have the Nifty chart on the daily time frame, and the very simple step that we are going to follow is we are going to search for what is known as an anchor bar. So I'll just mention this here. We are looking for what is known as an anchor bar. And now when it comes to an anchor bar, we are essentially trying to define what is an anchor bar. So here I'll say that if the traded volume for that day, I mean the time frame selected here is daily, or so traded volume for the period is 3 times the 20 period MA, volume MA, the 20 period moving average of the volume, then it is a anchor bar. Now logically, once I stipulate this criteria that we are looking for an anchor bar and I define it that it is basically when the price action is 3x of the 20 period moving average, logically the individuals who are watching this video will say, what happens if the price is not 3 times, but let us say if it is 3.3 times? Then my answer is obviously if it is greater than 3. So if it is greater than 3, and since 3.3 is greater than 3, that will obviously become an anchor bar. And now the question is, what if instead of 3, let us say I select 2 times? Then what happens? Now here I will say that each trader is free to define what is an anchor bar for them. It is very difficult to make an absolute recommendation, but I would consider 3 times. That's largely because, like you all know, I don't just trade Nifty. I will track maybe 200 odd stocks, 500 stocks. So this kind of a filter, 3x, helps me eliminate a lot of stocks, which allows me to focus on the stock that I want to deploy the system on. The other question could be, why only the 20 period? Why not, let us say, for example, the 200 period volume moving average? And the answer is the same as the previous one. It is up to the trader to finalize. That is, when you will back test the stock that you want to trade or the commodity that you want to trade, you will want to check where this holds good for them. And what happens if you do not get the volume chart for in your software for the index or for the stock or for the commodity or for the currency? Then in that case, obviously the system loses a key component, and it is best to not deploy the system there and look at other trading systems that we have discussed in the past. So I will just obviously wrap up this text and I will leave it here. And this is the definition of the anchor bar. And when we look at the anchor bar, the other key thing is that it should strike out. Like there should be no ambiguity. So for example, this point here, this particular candle where the cursor is, we all know that this is the Indian election day candle, right? So I'll just mark this slightly in a darker black form. And here you will see, once I bring the cursor, that the traded volume for the day, which is in the red color, the traded volume in the day is close to 1 billion contracts. And the average traded volume into the period was close to 300 million contracts. So logically here we are almost meeting the 3 times the volume bar. Now your point would be that this 3 time criteria is only happening once in the entire chart, and the answer to that question is that that's because we are looking at the chart of the index. It is very difficult for the index to breach the 3 times volume criteria because indexes are traded quite often, generally anyways, and because there are weekly, monthly, quarterly expiries happening, there is always a position that is getting settled. And in the event of a major event, that is when we see volumes rise. Um and typically 2.5 times or 2 times for the index is good, but I'll keep it to 3 times, simply for convenience, and simply because that candle bar, that volume bar truly strikes to the eye, and no real effort is required. So now it is clear that this basically becomes our volume bar, that is the anchor bar. And what is the hypothesis? The hypothesis is that if serious trading activity or serious trading volumes have been formed on a particular candle, then the high and the low of that candle are of extreme significance. The high and the low of that candle are of extreme significance. So I'll just make this blue and darken it a bit. And similarly, this candle also I will make it blue and darken it a bit. Now we can see that this volume found resistance at this level on the day and found support at this day. In other words, this high of the index on that day, that is approximately 23,180, and this low of 21,280. So we would remember that the index corrected by 1900 points on that single trade session. So this 1900 point zone is what we would say a critical zone, a zone in which we have to react. And now once we reach the critical zone, the question is, how do we trade it? The answer is very simple. If the price is coming from top into the critical zone, the approach will only be to buy. Whereas if the price is coming from the bottom to the critical zone, then the approach will only be to sell. And what will be the stop loss? The stop loss will be a close below the critical zone. So now, if you do not want to use the close, you can simply use an ATR. Like for example, if Nifty daily ATR is 250 points, you can simply subtract 250 points from the low, which will be roughly 21,000. So in other words, we will note that from this price action, we will note that on 13th of January, for the first time after breaking this anchor bar, on 13th of January, index actually closed below the zone. In other words, the positional or the price action trader is now going to use this entire region every time the market comes in this region to look at taking up long positions. This is the zone of entry for this trader. Every time the market is here, the trader will look at creating long positions. And because you are in a range, the trader will avoid keeping the previous low as a stop loss. Because you are in a range, it is expected that the market will create newer lows or inconsistent highs and lows. So therefore, this trader will avoid keeping that as a stop loss. And what will the trader focus on? Only if the price leaves the anchor range, then the trader will close the position. And if it leaves the anchor range on the downside, in this case, you will close the position. But what happens if the price closes above the anchor range? Then the answer is you will not create any new positions. So once we have the anchor bar, which as we can see was formed in the month of June, we had to wait for roughly 6 months for the market to come back and test the lows of the anchor bar. And after 6 months, so in a structural trend, a 6 month pullback after 6 months is quite reasonable. It's a good oversold condition value to plan your entries in. And so what the price action trader would do, the price action trader would simply go in the direction of the previous institutional support and stay on the long side. But since today the market gapped up and closed above this anchor zone, VR means those individuals who are looking at price action for trading simply cannot buy here. And now I will come back to the other theory on price action, that why can they not buy here? It's largely because if suppose I plot another horizontal line here, you will see that this is obviously a double top, right? This is obviously, so maybe a horizontal line is forcing your eyes too far behind. I will just take an arrow, and just if you focus on these two highs here, right, these are nearly similar. There is just about a 50 points, so I'll just bring this a little low. So these two closes are nearly similar. So logically, this is obviously a lower top, sorry. And here we don't need to have this text. So this is the lower top. that was actually created, and here we basically have the double top. Now, in other words, once we are seeing double top, we know that a trending security will have higher top, higher bottom kind of a formation. But here, what we are seeing, a lower top, double bottom, which means it is the first time that the market truly threatened to break out or to get back into a trend. And we can see it clearly failed and fell right back into the anchor range. And once it came strongly into the anchor range, it got bought equally strongly back into the anchor range. So because last time, you must understand that 3x traded volume is not representative of your trading volume and my trading volume only. It generally means extremely large institutions have bought and sold or taken decisions at that particular candle. And we want to be only where large institutions have done something in the past. We know that in the past, when the market did this at peak fear in the market, the institutions bought the market. So if they bought, why we know? Because we know that the price rallied upwards after that. So they bought the market. So what we are doing is, we are saying, okay, last time that the institutions bought here, even we will look to buying, and we will develop our long entry systems, factoring that we are waiting for the price to finally come into the bar. So every time the price closes above the anchor bar range, you will not take any particular trading action. Whereas if the price comes back into the anchor bar range, you will be compelled into deploying your long systems and use maybe an if you're using multi time frame technique, then you would use the shorter time frames to enter and wait for them to get oversold out there. Or you will create a system. For example, you will choose the midpoint of the range. So if the range is of say 2000 points, you will choose the midpoint of the range and just have an entry there. I mean, that is your system. So I will just maybe select this in the pink color to showcase where this is falling. So then your entry would be triggered exactly at the midpoint of the range, if that is your trading system. If your trading system is to do it on 1/3 of the range, you could do it here, or 2/3 of the range, you could do it there. But obviously, the farther away you go from the main anchor range, the lesser is the probability of it getting traded, but you will get a very, very good risk reward in that case. So it's a trade-off, and it's a decision that a trader has to make. That is how they will enter. The objective of this video was simply to couple a few price and volume elements and integrate them into our trading systems eventually in the future, and just use this knowledge for future applicability. Maybe the intention, of course, for me would be to give you all as many examples as possible, and to do that, what I will do is I will gradually cover different types of charts and only look at them in terms of price actions. That is, we are only looking at the anchor bar and the range. And now students would often ask that why is it that I just choose one variable and so on and so forth. And the reason for that is because if we choose just one variable and focus on it for some time, such that using it becomes internal or second nature to us, then we are ready to include another variable into our trading system. So why are we including more and more variables into our trading system? Because we want to make a trading system better. To make something better, something needs to exist in the first place. Since I have mentioned that 98% traders are trading without any decision making process, they are trading without a trading system to begin with. So therefore, these videos are in an effort to in the direction to help a trader understand how technical trading systems are created, and that there is so much of depth in just this subject also, and that even then, despite it being so vast and so interesting, even then technical approach is also not the only approach to be in the market. So it will help you, once you start appreciating that, it will help you maintain a neutral view towards the market, because you know that there are always going to be buyers and sellers, and you are just waiting for the right zone using volume. Just remember, we are using volume here to determine the zones in which we are going to participate, and we are going to check whether the price rallied above that zone and is pulling back in, or the price, let's say for example, if the election results, the market didn't like it and it continued dipping downward, then this same, if the price was exactly here, we would be selling and not buying here, if that were the case. So I hope that this video has taught you about what is an anchor bar, how we use it, and that the subsequent videos, as we cover more and more examples, they might be of some application to you. I wish you well. Take care.